Global markets remain volatile as commodity prices surge, central bank shifts gears, and tariffs policies stir sectoral uncertainties. To help us understand what this means for Indian equities in October, we have with us Mr. Devendra Singhal, Equity Fund Manager at Kotak Mahindra Asset Management Company Limited. Welcome to the show, Mr. Singhal.
Thank you.
So we know that gold and silver prices have hit record highs in September, driven by festive demand, safe haven buying, and global rate cut expectations. So how do you see this influencing an investor's behavior and equity market flows?
So far, when it started off, it was basically a hedge towards the gold, the dollar pricing, and the interest rates. But right now, many of the global investors or the marquee names have also joined the fray, and they're saying that the way the dollar is likely to depreciate, then gold and silver both are becoming a safe haven. This was augmented by sovereigns started buying gold first, and now silver also has become a part of the overall kitty with a couple of sovereign funds therein. Retail investors generally have been the last ones to join the bandwagon, but there are with ETFs, it is now getting even fizzier. So I think this momentum is likely to continue for some more time before we see a blip therein. So yes, I think we would see or we should be seeing a lot of retail investors jumping into the fray, and this could easily be seen with the amount of ETF purchases which are happening on the silver and gold side.
So we know that pharma stocks saw volatility amid tariff concerns. Do you expect any acceleration in diversification into non-US markets and push innovation in complex generics and biosimilars?
See, even if you expand into or diversify into other markets, US would continue to be the biggest spender on pharmaceuticals there. Now, Indian pharmaceuticals in general is more generic than branded, but there are a few companies who are doing into a lot of branded also. But the US, the new law says that you have to have a manufacturing plant there.
Yes.
So they quite a few of them have few plants there, and it would not be difficult for them to shift the production to that site. Sentimentally, it has come to a shock because people have not realized it and not analyzed it completely. But I don't think it's that bigger, trigger for the Indian pharma stocks to behave as what they did in the last month was this tariff hike news which came in. But yes, diversification to other markets is always welcome because it spreads your base. But as I said, US is the largest market and is likely to continue for a long time.
So the Fed's 25 BPS rate cut and guidance for further easing sparked rallies in IT and pharma stocks. Do you expect this to revive the FII interest in Indian equities, which saw outflows in recent months?
See, if we look at the flows from the FIs, they continue to be pretty volatile and move in the negative direction so far. Now, while the interest cut is definitely positive for flows into the emerging markets, direct flows into the Indian markets, I think it's not as easy as what it sounds like because currently the direct flows into the Indian markets are not very large, but flows to the emerging markets are gonna increase and they are increasing, and rightly so because these markets have not been participating in the overall rally over the last couple of years. So the differential between the historical averages of these emerging markets and Indian market is basically and expanded. This is now shrinking. We're seeing more money going into the other emerging markets than what we're seeing in India. But I think it's sooner than later that you would see the flows coming back to the Indian market also and in hordes.
Could you name a few emerging markets?
For example, China, there has been one market which has been reeling in a lot of pressure. But over the last 1 year, you have seen a lot amount of flows which have gone into the Chinese market alongside the Hong Kong market also.
So, with RBI likely to follow suit, how should investors position themselves in rate sensitive sectors like banking and real estate?
Generally, when the interest rates are declining, you have to be, present in, or typically the rate sensitive sectors tend to do better. As you rightly pointed out, banking and real estate are two direct beneficiaries of these sector. So is the utilities, which have a basically fixed cost of capital employed coming in and fixed returns being governed by the government. Now, typically in a falling interest rate scenario, these sectors tend to do well. Our view is that we are also positive, but real estate as a sector is also, has been pretty more volatile than what has been over the last couple of years, and so has been the banking. But I think over the next couple of years, we do see banking to perform pretty reasonably good than what we have seen in the last couple of quarters, at least therein.
So, despite strong GDP growth and a sovereign rating upgrade, India underperformed global peers in equity returns. What do you think is driving this divergence, and do you expect a reversal?
While the last 1 year we have seen Indian market not performing as well as the other emerging markets, but if you look at the post-COVID, there's been a very sharp outperformance by the Indian equity markets over the other emerging markets. So over a longer period, Indian market has still outperformed the emerging markets. It's as we discussed in the earlier question also, the recent underperformance of the emerging market is basically what is yet to move flows going into that market, and which is where the outperformance is also happening. But I think the way the Indian GDP is shaping up, the credit ratings are improving, the fundamentals of the markets are improving. I think it's only a matter of time when you see more and more flows from the FIIs coming into the market. And now we are seeing, more avenues for foreigners. Even the normal investor sitting out in US, they can also start putting in Indian market. We are seeing a lot of interest. I think it's only a matter of time when we see those flows coming into the India.
Also, please tell us what, according to you, are the sectors or themes that are best positioned given the macro backdrop, festive demand, and policy reforms.
See, the way we see is that consumption as a theme should be very, very good for the next couple of years. This is largely because it's a very domestic focused theme and very little influence from the exports side. Exports, as we said, because of US being the largest consumer, is a pretty volatile because of the staggered thing and the trade negotiations going on. Two, on the other side of it is the domestic consumption theory, as a story, which is basically your automobiles, your consumer discretionary, and likewise. So I think this is one theme which we see that should do well. And now with the recent GST rationalization, before that the tax cuts and the interest rate cuts, it all starts adding up to the overall consumer wallet, which is going to be spent on these. So we are very positive on this theme going forward.
So, what would be your advice to the investors who are trying to rebalance their portfolios amid global uncertainties and domestic resilience?
See, whenever we talk to the investors and we they ask us for suggestions in terms of portfolio allocations, we tell them that if you are looking at a holistic approach, you should diversify your assets across multiple investments across multiple asset classes, be it equities, debt, or commodities like gold and silver. But if you are looking at an equity market, please have a bigger time horizon, let's say 7 years, 10 years, for you to make the most of it. So if you're coming and you have a risk appetite for waiting out for the results for 7, 10 years, and you can withstand the volatility, equity markets or in a diversified equity market fund is the best option. But if you want a smoother ride, I think something like a multi-asset or a balance advantage fund would also be a good option for the consumer or the investors to look at and invest in.
Thank you so much for joining us, Mr. Singhal, and sharing your insights on the evolving equity landscape.
Yes, thank you.
We hope this discussion helps the investors gain some confidence and navigate October with more clarity. For more such discussions, stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.